My name is Mark Shawson, the Pattern Trader. So we have so many of our members on this webinar. It's great to see the support that we have continuously turned out from our members. And for those of you who are new, let me just briefly introduce myself. My name again is Mark Shawson. I started the Pattern Trader in 2015, basically to educate people on how to recognize price action and price patterns. So I'm often asked the question, do I trade on the news? And the short answer is no. And I'll go into that in a little bit. Price is a discounting mechanism. Price is ahead of the news. Everything is filtered into the price. And so I just look at the price action on every asset class. So it doesn't matter if you're trading crude oil or pork bellies or the euro versus the yen or IBM stock or gold. You can use all of the technical analysis that I'll be talking about over the next several days. I started this business many decades ago when I was in college. I was going to one of the best business schools in the country, University of Southern California out in Los Angeles, and studying how to make investment decisions on what we call fundamental information. So fundamentals are when you look at a company and you break it apart and you look at the price earnings ratio, you look at the sales to inventory ratio, you look at the management. If you're looking at a cocoa market, you're looking at exports, you're looking at the dollar. So you're making investment decisions based on what we call fundamental information. But to me, the markets are a forward-looking mechanism. The markets are always looking ahead. And so even if you can see information today, the market is not looking at what the information is today. It's looking at what is the information going to be next week, 3 weeks from now, 3 months from now. And this is why I study price and price action. So again, my abiding philosophy is that price is a discounting mechanism. And what does that mean? It means that price is effectively ahead of the news. I'm going to show you some charts where for a year and a half, I was predicting that Tesla was going to fall from $1,200 to $400, that it was basically going to drop by 3/4. And that's exactly what we saw last year. Now, Tesla was adjusted. It was split 3 times. And so it's trading at about $100 now, and it fell from $400. So Tesla was down 70% last year. Now, I was saying to our members for a year and a half prior to Tesla collapsing at the end of the year that this was going to happen. Now, how did I know that? The only way I could know that was by studying price, and price is ahead of the news. So we can say that, Tesla crashed because Elon Musk took over Twitter, but that was only late last year. The price patterns and the price action was telling us that Tesla was going to crash, and the reasons always come out later. The why is not important to me. To me, it's where, when, and how much do I have to risk on any given position. So to me, amateurs trade stories, but price is the only truth. When we talk about stories, I remember looking at CNBC one day, and Kevin O'Leary, Mr. Wonderful from Shark Tank, was, telling us about Zoom. I was short Zoom, and it was right before the earnings. And Kevin O'Leary came on and said, you've got to think of Zoom as a new telco, a new paradigm, a new way of communicating. And so I was short when he was saying, this is, just a new paradigm. And, this is the conflict. When you look at news, you get you get confused. So this is why I say you have to be objective. There are all kinds of information swirling about the investment markets today. How hard's the Fed going to go? Are we going to have a recession? If we have a recession, is it going to be a soft landing or a hard landing? What's going to be the terminal rate? When's the Fed going to pivot? We've been hearing that conversation every hour, every day, every week, every month for the last 3 months. And you cannot make objective trading decisions based on listening to that. So there are going to be all kinds of things buffeting the markets this year, the Fed, recession. And so you have to be entirely objective. So to me, price action is the analysis of price charts, and it helps us define two things: objectively define where to enter a position, and then objectively identify levels to manage your risk. And that's the holy grail of trading. If you know where to enter a trade and what your risk is, you've got a good deal of this game beat. So to me, the advantages of price action is that price action tells us where on the charts to buy or sell without second guessing ourselves, how to establish optimal entries and exits, and how to protect your account and maximize your profits. And by using price, you can diversify and trade in bull or bear markets, trade markets that are going up, trade markets that are going down, and you can trade any asset class. So you don't have to have specific fundamental knowledge on how a treasury bond works or how the euro yen works. So you can diversify across foreign exchange, stocks, gold, oil, commodities, and whatever you want to trade. If it has a high, low, and close, I can trade it. So I basically put together a few thoughts on how to achieve consistent profits over time. Obviously, putting on a trade is effortless. We all have screens and fancy technology, and it's fun putting on trades. But it's all about having the discipline. And what I try and do is hone in on the best risk to reward opportunities. Those opportunities that have a 3-to-1 risk and reward. And that means if you're going to risk $5 on your stock, you should see a pathway to make $15. And you can lose a lot of trades if your risk reward is 3-to-1. Now, to me, the biggest problem in trading is discipline and being unemotional. And I struggle with that. So I've kind of built this rule. I built the framework for the pattern trader really around myself to help myself give myself governing principles to keep myself out of trouble, because I will trade a 5-minute chart, I'll trade a 1-minute chart, I'll trade a 4-hour chart. But to me, I feel if you stick to the longer term timeframes, daily, weekly, monthly, this will give you bigger moves, bigger outcomes, and eliminate all the ups and downs. Now, I've also found that either buying immediately within the first 15 minutes of a market opening or on the close is the way that I have found that I avoid all of this emotional intraday trading. And intraday trading is just gambling. When you're looking at a 15-minute chart, a chart can go anywhere in the next 15 minutes. Yes, you can spot double tops, double bottoms, and all the things that I look at. But the thing is, they won't sustain on a 15-minute chart in the same way that they'll sustain on a weekly chart. And also, I think that we're all humans. We're not bots. So I try to limit my trading to no more than 3 positions at any one time. I can't keep track of all of these things. And certainly when the market starts swirling around, it's very, very difficult to keep track of it. So the idea is to find the best trading opportunities with the best probabilities. It's not quantity, it's quality. And then it really comes down to risk management. If you protect your risk, and especially in the FX market, if you limit your risk to 0.5% per trade, you can lose 10 trades in a row and only be down 5% in your account, where most people are trading too much and risking too much on each trade. And it's all about controlling the risk. So at the end of the day, it comes down to being in control. Wait for the market to come to you. If you find you're chasing trades, if you feel like you've missed something and now it's going and now you got to jump in, you can feel very quickly that you're out of control, that you're in a reactive mode. So to my mind, the way trading should be is that you should anticipate understand what the market's telling you, understand the price patterns, and anticipate where prices are going to go. If you find that you're reacting, this is where things are likely to go off the boil very, very quickly. So if you follow these principles, there's no reason that you won't be hugely successful. And that's what I try and do at the Pattern Trader, is give you the education and give you the tools to become highly successful. We have a Trustpilot page that you can go and look at all the testimonials from hundreds of our members around the world. So it really boils down to a 4-step trading methodology that has taken me decades to figure this out. So the first thing, when I open up a chart, I want something to jump out at me. If it doesn't jump out, I just move to something else. So when we open up a chart, basically what I want to see is this market going in one direction or another? Is it in an uptrend, or is it in a downtrend, or is it just a sideways channeling market? Now, there are two other variables to an uptrend, downtrend, and sideways market, and that is a market that is turning. One that's turning from a market that's been bullish to one that's bearish, or turning from a bearish market to a bullish market. And frankly, that's where I make a lot of my money, on the turn. Today, the Dow Jones went up and started turning lower, and I made all kinds of money on that turn. I'll show you what I did in just a moment. So the way I identify a market that's going to turn is that there's always what I call a governing price pattern. Before a market turns, there's a price pattern, a head and shoulders, a double bottom, an inverted head and shoulders. There's always some price pattern that precedes that turn. And then I try and corroborate what I feel like I'm seeing in terms of the pattern with what I call the price action. And there are two forms of price action that I've coined an insurance bar. An insurance bar can be on a daily chart, a weekly chart, or a monthly bar chart. And they come in two forms. One is a key reversal. And again, I'll discuss this in more detail. And this is what we saw again today in the Dow Jones. Dow Jones made a new high, close on the low. That to me is what I call a key reversal, where it goes higher and closes on the low of the day. Another form of an insurance bar is an inside bar. And I'll show you a chart today with an inside bar that I think is a tremendous signal going into tomorrow. So once I kind of identify the trend, then the chart pattern, and then I drill it down to a certain day where there's a turn, a key reversal, or an inside day bar, then I look to confirm all of this analysis. So all of this analysis is really very subjective. It's my way of looking at things. And ultimately, I want the market to confirm what I'm looking at. So my philosophy is the market is always right. I'm right some of the time. The market is always right. So I'm always looking for the market to confirm what I'm thinking. And so if I'm looking to buy a market, I'll put a buy stop slightly above the high of today's range. Or if I'm looking to sell short, I'll put a sell stop underneath the inside day bar or underneath the key reversal. And I'll go into this in real time. Hopefully this will make more sense as we go along. So these were some of my predictions in Tesla, going all the way back to January of last year, where I started talking about Tesla as an implosion. And this was when Tesla was still trading at the very highs of its trading range. So now Tesla has split 3-for-1 since this time. So it's, basically on a split adjusted basis, it would be trading at $300. But Tesla's trading at $100 in the market. So it's gone down 70% since I started telling our members to sell Tesla. And all through the year, I was saying short it at 1,000, short it at 800. Even, the end of last year, where it was trading at $187, this was in November. A month later, Tesla dropped to $100. So you could have made almost 100% just on that one signal. Now, these are my trading positions currently, my open positions in the stock market. So I'm short BNTX. I came in short, and then I shorted into the high of the day. I actually put on more. I sold more at 152.5, and it closed at 148.5. I'm also short the stock of Moderna, and then I also bought put options on Moderna. A put is a bet on a market decline. And so right at the high today, when Moderna is trading about $185, $186, I said that, it's likely that the market's going to turn, and I'm going to show you why I'm anticipating that. And put options, or options in general, are highly risky. So you have to be prepared to risk every dollar that you put in. So in this case, I put in about $20,000, a little bit more. And if it doesn't reach my objective, I'm going to lose most or all of that. But that's the bad part. The good part is that my risk is entirely limited to my investment. So being short can be a very dangerous game. The market can keep going up and expose you to unlimited risks. But if you buy an option, you can only risk what you put up. So those are my stock positions. And then these were my FX positions, or my cash positions in my FX account. So I'm short some dollar yen. And then I very actively traded and shorted the Dow Jones. The US 30 is the Dow Jones 30. Made some very nice cash as this thing crashed on the close. And then I'm likely short some silver. Now, these are all trading positions. I may be in them, an hour later, or out of some of them tomorrow. I imagine I'll start taking some profits on these Dow positions, and then wait for another time into tomorrow's opening to perhaps short some more. So just give you an idea of what we do at the Pattern Trader. So every day I send out an email. It could be a currency trade, it could be a stock trade, it could be a gold trade. And what I try and do is show exactly what I'm looking at in the market. So this is really an education tool. Everybody's going to be focusing on the trade. What did the trade make? But the idea is, what I'm trying to do is show and educate our members, so that whether you're looking at the New Zealand dollar Canadian, or the euro yen, or IBM, once you understand price action and price analysis, this will enable you and liberate you to make these decisions on your own. So this was in the New Zealand dollar Canadian pair sometime in August of 2022. And based on these long-term price patterns, these bearish price patterns, I said, sell this at 80.25. Then I believe we put on another position at 79.95. And again, I'm looking for bigger moves in the market. And this was the output. Had 3 trades on and made over 6 figures on those trades. This was a gold trade. When gold broke a certain area at 1800, and then also silver. This was very fertile trading positions last year, last August, and or actually that was back in June. And so this was, some of the trading profits that, I made in the metals in that run. So this was the dollar yen. I was telling our members to buy this in a breakout of 110, then 115, and I predicted it was going to go to 150, and it went to 150 on the nose. Now I'm short the dollar yen. So again, this is a dynamic market. You have to look at things very fluidly. And that's kind of the principles that we trade. Here's the euro yen weekly. Had another buy order there. And this was the output of those trades. So this is what I look for. We don't get them every day or every week, but when you snag trades like this, you can obviously make a big difference in your trading and your life. So, again, sometimes the markets offer us opportunities where we can take advantage of these giant trends, and I'll be in the market for 3 weeks or 3 months. And then there are other times where the markets are unyielding. They're not really going anywhere. And, I'm likely to be much more active and hold positions for much shorter time frames. So it really depends on, what I'm looking for in the market and where the market is in terms of its maturity and its development. So let me just, start breaking apart, how I look at markets and how I analyze markets. And that's really the purpose of this little get together, this webinar series. It's not about, picking winning trades and, looking at setups. It's really what I'm trying to do is, educate you on a way of looking at markets based on price structure. So whether the trade wins this week or doesn't is not really the point. The point is to understand market action and set up trades where you understand risk and reward. So I'm always looking to find pockets where I can hang out and understand where my risk is. So I'm going to start by looking at the indexes on a pretty big picture basis. This is a weekly chart of the S&P 500. This is a major stock index in the United States. And then below that is the NASDAQ, represented by the QQQ ETF. So these are the stock markets in the United States. And so there's always a debate whether technical analysis works, whether price analysis works. And to my mind, I've been trading for decades, and it's just amazing to me how markets adhere to certain defined channels. So actually, this goes back a little further. I should have actually taken a much bigger snapshot. But these lines, just ran for about a year and a half. You could have traded against the upside and against the downside of this channel for a year and a half. And then right as at the start of 2022, the markets turn. And you can see that they have been coming down in a very defined way. You have this downtrend line, so you kind of have this V top now. It looks like a roof. And this is a V top. And with the word top in it, it means that the market is going to go lower. So I look at patterns to tell me what is happening on the global picture, and then I look for ways to get in sync with those patterns. So you can see how neatly this has been observing this downtrend line. Every time it comes, it rallies, comes right back to this pivot point. Now, I thought by virtue of this trading action in the last couple of weeks that we might have a chance to go back to 4,100. But today we had very, very negative price action, and this thing is already turning down. Now, this is a weekly chart. So, I'm not going to be able to, or I will reserve making a judgment on the weekly chart until the end of the week, until the bar is actually closed, because this is just still arbitrary. We're one day into the week, and we have to wait for this to tell us how this is going to resolve. Does it look like this? Does it look like this? And this is why I always make my decisions based on the close of whatever time frame I'm looking at. So this gives me a guideline. Once I understand what's going on in the weekly, I understand where the resistance levels are, where the support levels are, then I can drill it down to a shorter time frame. Now you can see that there's another line that comes in down here. So you kind of have this downward trending megaphone top. It looks like one of the, a megaphone that a coach would yell at through the sideline. And basically this tells me that this is coming all the way down here, which is about 2,800 on the S&P. So there is, I think, an awful lot of chaos left in, the trading, and certainly in the first half of the year. Now, what makes me nervous is that this is the general thinking, that the first half of the year is going to be rough, the back half of the year we're going to rally, and everybody's thinking the same thing. And so when everybody thinks the same thing, it makes me really nervous. And this is what kind of gave you a little bit of a short covering rally on Friday. When everybody's caught off sides, then the market goes the other way. And so everybody is so bearish that I thought, well, we may still have another shot back to 4,100. But you can see that the market, went up today and now it's reversing. So I always look and see how the market plays around the previous unchanged level. And unchanged, what I mean is the previous close. So this is what was happening in the Dow today. The Dow basically from Friday opened higher. And then when it started coming back down and started to look like it was going to go through the previous days unchanged, this is where I started shorting it. So this sets up the premise of what I call a key reversal, where the market goes higher, and by the end of the day, week, month, whatever time frame you're looking at, it closes lower. This is what I now call a key reversal. Makes a new high, closes on the low. And we'll take a look at the daily price action. It closed right on the low. Now, you can't just trade reversals in a vacuum. But if you look at it in context with what's going on, this is basically a way just to give you more information and put you on the right side. So you'll notice that every time this thing made a new high, it made a new high for the week. And by the end of the week, it closed on the low. Made a new high, close 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 on the low. And we'll have to see how this looks by the end of the week. But every time you made these highs, it was followed by lower lows. So I look at a combination of the price pattern, the trend, and the price action. And when it all starts adding up, this is when you can put on high probability trades. So basically, when I look at a chart like this, I say, A, we're in a downtrend. So the first thing is to recognize what is the cards you're holding. Now, this is a weekly chart. And I think the big shortcoming that most people are, and the struggles most people are having, is because they're focusing on very short time frames. If you're looking at a 15-minute chart or an hourly chart or a 5-hour chart, you're only getting 5-6 days of history. So you really don't understand the big picture. And by understanding the big picture, at least you can get in sync with what's happening. So this is a downtrend. Now, that's not to say that the market is going to go straight down. In fact, bear markets or downtrending markets are the most difficult because they have these huge, very quick short covering rallies. We call these bear market rallies, and they are profound, and they don't let you out. They don't let you breathe, and they keep going up. And so, when something just keeps going up and up and up without a downtick, after a while you start questioning, this is an up market. I got to get long. But this is the nature of bear markets. They put on these rallies and it looks real every time, only to be followed by lower lows. And I think this is what's happening here. You get a rally, but then eventually it all just peters out. So the first thing is to understand the cards you're holding and then wait for the price action that corroborates one side or the other. And by corroborating, you can see we've now got what looks like to be a potential key reversal bar. So you could trade on the daily or the weekly time frames, and if by the end of the week we look like this, now we'll have a key reversal in the direction of the trend. And now you can set up your trade. You can short here, you can put your stop loss there, and you can set up a risk reward trade. And that's what it's all about. Finding a pocket, finding a bar within the cadence of what's going on that gives you an understanding of what the risk reward is. So that's the S&P. Let me just kind of remove some of this. On the chart below that is the NASDAQ. And this also had a very nice trending line up. And now you can see it's got a perfect line with all of these intersects. So you can see every time we go exactly to a price point. Now, we're in an area where I thought there was support and that maybe we could get a lift back to the 285. But this market is so weak now that, it looks like it's failing very quickly. But we'll have to see. This is still very much an area where you can see there's a lot of support, but then there's also a lot of resistance. And so this is a market where you kind of have to walk and chew gum at the same time. Sometimes I get it, long a stock, but knowing that the big gale force winds are really going to come this way. So it really comes down to understanding the cards you're holding. Now, I'm looking at two stocks that I think will be the Tesla of 2023. So what I'll do actually is I'll put, let me put Tesla up here to show you the overlap. So again, my whole abiding principle is that the markets are a forward-looking mechanism, and the market shows you where it wants to go in the form of price patterns and price action. And on the top chart, we have Tesla. Now, again, you can't really see all the way at the beginning here, but this is a parabola. Let me just kind of put it up here real quick. Just let me just take a picture of this first. Let me try and. So you can see with Tesla, it started out at nothing. And then, let me just get out of this thing. I always take for granted that people understand what I'm talking about. That's not a good idea. So with Tesla, it went from $0 to $400 in a very quick fashion, in what looks like a hockey stick. Whenever you see these hockey stick curves, sometimes you see these projections of companies that go public and they just show like earnings growing to the sky. Whenever you see something like that, alarm bell should always go off. This is called a parabolic curve, when something goes up very, very quickly. And typically, and almost every time with a parabola, the way you come up is the way, as fast as you go up, you come down just as fast. And all the way up here at $400, I said Tesla is going to be a $50 stock. This was a year and a half ago. And we're at $100, but I think 6 months from now, I wouldn't be surprised to see us down here. And how do I know that? Well, first off, this is a parabolic curve. And then at the top, we see some very defined price patterns. And this is very simply a double top price pattern. You make a peak, you back off, you retest that peak. And when you come through this, let me draw this a little bit better. When you come through this line, which is simply a line that's drawn through the pattern, that basically tells us that this double top has been confirmed. Now you can see there were a number of shakeouts after that. But this was your cheat sheet. Once a pattern has been established, basically that pattern tells us where this market is headed. Now, how it gets there, what time frame that's the fun part. This is the unknown. But what is known is that if a market has made a top over time, it's going to go in the other direction. Now, in addition to that double top, Tesla also made this big, large head and shoulders price pattern. So head and shoulders, just what it sounds like. Looks like a man or woman's left shoulder. The peak is the head. This is the right shoulder. And then when it cuts through the neckline, which is simply the line drawn throughout the pattern, that is and that was where, I said at $180, get short again. Late last year in November, I said, get short here. And it went from $180 right down to $100. So a simple understanding of price patterns can then lead to these kind of market outcomes. So Tesla has traced out these huge bearish price patterns, which tells us, by and large, this thing will keep going down. Now, there's all kinds of challenges. You could get a retracement here. Like I said, how it gets there, that is kind of the unknown. And then we just use price action to set up risk-reward probabilities in the direction of the trend. But the first thing is to understand the cards you're holding. And Tesla told us right then and there that it was over. When all the analysts were saying that it was going to double from these prices, I was saying it was over. And it just, price action tells us that. Now, the reason I point this out is because we're now looking at the price chart of Moderna, which looks remarkably like the price chart of Tesla when it was up here. We see this huge move to one area, backs off, comes to another area. We back off now, and we have this double top. And basically, when you go through that neckline, you confirm that this top is in, and by and large, over time, we should see this stock go lower. And I do believe, probably by the end of the year, that we should be a lot lower in Moderna. Now, Moderna has also traced out a short-term kind of symmetrical triangle. And what you can see here is in the last 3 weeks, all of this price action has sat within the range of this bar 4 weeks ago. So all of this is what I call an inside bar coil. Now, this again is a weekly chart. So for the last 3 weeks, 4 weeks now, you've basically been trading within the trading range 4 weeks ago. And so what this coil represents to me is a storing of energy. That it's just, coiling within a trading range, and that we try and surmise which way the energy is going to break. And by virtue of the preceding pattern and the preceding trend, you have a downtrend that has a huge double top sitting on it. So something just flipped on my charts here. Are you seeing my screen? Let me just share this.
The screen got cut off for a second.
Yeah, okay, I see that. So are you, everything good now?
Yep, it's back.
Okay. So now when we see a coil like this, I call this an energy coil. Because to my mind, I'm looking for this to really unleash one way or another. And we try and look at the previous trend and the previous patterns to deduce where that might break out. So again, what I try and do is put in execution orders to confirm what I'm looking at. So just because I'm seeing something I want the market to confirm it. So in this case, you have these two lows last week and the week before. And if you want to be real conservative, all you do is put a pending order here, put a sell stop underneath these lows, and then let the market do all the work. So this is a pending order. I'm not going to get into the technicalities on how orders work. You can check it on through your broker or YouTube. But this is what's called a pending or a resting order, where you put a sell stop underneath these lows. And if the market goes back up, no harm, no foul. If a week from now or a day from now, whatever, it comes back and triggers this thing, you're likely to be put into a good trade. And the nice thing is that now you have these kind of narrow range bars. So you could effectively put your sell stop there and your stop loss there. And this is your risk. And this is what your reward looks like. So to me, what I try and do is find areas where I can find very small levels of risk for much higher outcomes. And even if you're wrong a whole bunch of times, all you need to do is be right on one of them, and it makes up for 5 or 10 trades. And that's what I do. I try and find these moves that trigger these larger outcomes, because that's how you make money in the markets. Getting in and out and every day is a blood sport. Very difficult to come out consistently profitable. You need these bigger trades. When Tesla goes from 320 all the way to 100 in a straight line, that's how you make money in the markets. So I'm going to kind of stop here. I'm going to, look and see what the questions are. So Duncan says, I made a ton of money on those Tesla trades. So Simon says, so if you're only trading no lower than the daily time frame, can you do your analysis on the close Friday and then over a weekend, then place trades in the opening? Yes. So Simon's asking, so again, you can analyze things on the daily or the weekly. So this is a weekly chart pattern. And so to your question, Simon, you can see that once the market identified what was going on, you had this top and this top. So you had this double top in here. And then you had this retracement. You have this rounding top, and then you had these 3 key reversals. Made a new high, close on the low. Made a new high, close on the low. Made a new high, close on the low. Now we'll see this kind of triple action on gold in exactly the other way. Gold did this, had all these key reversals in one area, and whereas Tesla had this rounding bottom or this bottom, gold at 1600 had this bottom and gold went to 1850. Tesla had this triple top and went from 300 to 100. So I look at a combination of the pattern. So you have this triple top, if you will, and then the price action, where on each one of these weeks, Simon, you made a new high and closed on the low, made a new high. And so very simply, you could have entered your order on the observation of this weekly bar. You could have put a sell stop there. This was your stop loss. And now you could have been in that trade. So yes, in fact, the more disciplined you are, and the more you just focus on the close, whether it be a daily close or a weekly close, this is what is going to give you the discipline and the capability to stay in trades for longer. When you're looking at everything every 10 minutes, there's just no way you're going to stay in that market. The market will figure a way to just hook you out of it. So the whole thing is to be unemotional and objective. So you can very easily analyze things at the end of the week, Simon, and make a ton of dough. So you can see that on the case of Moderna, I'm looking at it through the prism of this ascending broadening thing and saying that Now this thing is likely to keep going lower. That I think that you saw the high and it's going to go lower. So like I said, I either look for what I call a key reversal. You can see right here where this thing made a new high and then closed at the low of the bar. It was a very big weekly bar and it closed on the low. And by closing on the low, it tells me that the sellers are in control. But, you know, reversal in and of itself is in a vacuum is not really meaningful. You have to see the preceding pattern or trend that gives that relevance. Now, as I said, there are two insurance bars that I look at. One is a reversal, like we saw in gold, makes a new low, close on the high, or Tesla makes a new high and close on the low. And the other is what I call an inside bar. So you can see right here in Moderna, you had an inside weak bar. And what I mean by inside week, you can see the trading range of that week sits within the trading range of the prior week. And so, again, you can use this analysis by then placing your sell stop underneath here and your stop loss above the high. So now this is your risk and that's your reward. And you can see since that stop was triggered, you're still trading underneath there. You're still trading underneath this low. The patterns don't need to be perfect. By perfect, I assume you mean, Shazan, that when I say this is a double top, people will say, well, but you know, these tops are not even. And that's a good call, Shazan. It doesn't have to be perfect. So you can have a top that actually, this one top actually exceeds this high. But I think we can all agree that if we look back, we can then say this looks like an M top. This is kind of a perfect top. But sometimes the price levels won't be exactly even. So, you know, I assume a lot, and that was a good call. So even though this was lower than the other one, I think we can all agree that when this thing is culminated, that it looks like the letter M, what we call a double top. Now, here's the thing about patterns. The markets will always be throwing you patterns. And this is the trick to figure out which ones are real and which ones are fake out. Now, it's only taken me about 40 years to figure that out. So this is what I think, you know, I bring to the table at the Pattern Trader. As I said, what I do is show you how to focus and capitalize on the opportunities, but also to avoid the market traps. And this is probably a good example of what I mean. So in this case, we have a double top here, and then this whole thing is a double top. Now, how do we know that that's really a top? Well, it's just followed by price confirmation. Now, you can see what happened was, you know, after this top was formed, that prices started making lower lows. So why I'm pointing this out is that you could have very well said, well, Mark, why isn't this a double top? And it went on to make a new high. And that is the nuance of the markets, is that I see the patterns and then I try and see what does the market do. And this is a whole other discussion. You can see here was an area where you could have said, hey, Mark, this is, you know, why wasn't this a double top? Because it wasn't confirmed, because this is what the market will do. It will sucker you in to making very bad decisions. So you can see this would have been the neckline of this double top. And if we had come through here, then we could have seen that kind of ensuing price action. But you can see this is what prices do. They form these patterns And it looks for all the world like, hey, I'm just going to jump in this thing and get ahead of the bus because this is where it's going. But you can see how this thing just stopped short of this neckline, just stopped short of these prices. And this was the trap. So what I do is I look at these patterns in Restoration Hardware and Ferrari. Both of them made double tops, but I was predicting that they were actually going to go on and make new highs. So there's a whole nuance around these patterns. And Tesla was the same thing. This thing stopped just shy of going through this neckline here. So you got almost to the neckline, but you never penetrated. And the neckline is the confirmation. When you go through the neckline, that's when you confirm the pattern. So you can see here we went through the neckline, and then subsequently it was taken out. So the market will throw you a lot of looks and sucker you in. And let me give you an example of exactly that. So every morning I do a session called the boiler room. This is when we go into the market before the market opens. I go in, it starts at 8:45 Eastern time. And I was talking about both these opportunities last week. So this is an example of how a double top is not a double top. It's when the prices don't confirm. So the top chart is RH, Restoration Hardware, and the bottom chart is Ferrari, ticker symbol RACE. Now you can see that a couple weeks ago, RH formed this very nice head and shoulders a double top in the direction of the trend. Now, when I see a pattern, I then look for what the market tells me once that pattern has been formed. So if I see this bear pattern, what you typically get is a breakout below the pattern. You get a retest of that neckline, and then you go and make a new low. That's typically, if this is a true bear pattern, that's what it should look like. But this is what I've learned, is that you have to look at the patterns, and then you have to look at what does the market do once the pattern is formed. So you can see once this bear pattern was formed, it triggered, and then it basically went nowhere. And so this started to send all kinds of alarm bells. When this went below the neckline and then started going above it, I said that this thing is likely going to go that way. To my mind, it's very simple in trading. If a market's not going to go down, it's going to go the other way. And by virtue of the market not doing one thing, I'll very often just get on the other side of it. And this is what we call a busted pattern, where we have a bear pattern here, but the market starts ignoring the implications of that pattern. And by virtue of busting it, it just means you get on the other side of it. Now you can see Ferrari did exactly the same thing. Put on a very nice looking double top, had a little bit of a sucker play underneath it where you were chasing it. And then the minute it started to trigger this neckline, which I said in the boiler room last Wednesday or Thursday, I said the minute this thing triggered here, I said this thing's going higher. So I know this is very nuanced. Some of you are very new. I didn't really want to get into the weeds of this. I'm just trying to show you how powerful price is, how powerful, if you understand how price works, how you can put this information on your side. Simon says, do you look for patterns in a trending market? I look for patterns appear all over the place. Bear pattern. So this is race. You know, we had a double top here, and you could have made a nice trade down there. And then you started turning into an inverted head and shoulders. And then you got into a rounding top. And then you got back into a double bottom. And so this is kind of a sideways market. I don't love sideways markets, but within these markets, the markets give you patterns that then you can trade. So sometimes, you know, I look for, you know, to get in a trending market, I'll go with the trend, but within the trending market, you get these counter trend rallies. So as long as you understand this is just a counter trend rally, I will trade those rallies. You can make a lot of money on those counter trend rallies. So again, I look at a combination of patterns and price action to take advantage of whatever the market is doing. So you can see very subtly in here, this looks just like a lot of crap in here. But very subtly in here was this double bottom. Now, again, not perfect. You have one low above the other, but this is a bottom. So all the way back here, this thing put in a bottom, then it put in another bottom. And if you understand through all this crap, look sideways, but this is the governing patterns behind this trade. And so once you understand the governing patterns, then you want to get in sync with whatever the pattern is telling you. John says, very understandable. Thanks again, John, for your support. And so Simon says, definitely no need to have moving averages or RSI in the chart. Simply certain price patterns together with price action, insurance bars, all that's required. And I guess just plenty of screen time to get familiar and recognizing everything. So Simon, that was, you know, well said. So yes, you will notice on this chart, there is nothing but price and time. So I have two charts here, two very different sectors. One is an EV or car maker, and one is a furniture maker. And it really doesn't matter what these charts are. You should be able to look at these charts, and whether it's corn or natural gas or the euro versus the yen, you can make decisions. So this is what I call a naked chart, because there is no volume. There are no Bollinger Bands. There are no moving averages. There are no MACD. I'm just looking at price and time. From a very simple picture, I can extrapolate all kinds of money just looking at patterns. Rounding top, double bottom, a fake double top that's now taken out and busted. Ibrahim says, future, is there any way we can get copies? And I should have done that before. Let me do that now. Ibrahim, thank you for asking. And I neglected to do that. Typically, let me just share with you a strategy workbook that includes most of my common patterns, as well as the scientific basis behind them. So I tasked my team to actually see if there's any method to the madness or the madness to the method behind what I do. And they showed that once a pattern is established, you then get at least 100 days of markets moving in a certain direction from a pattern. So I included that strategy workbook in the chat box. And Abraham, thank you for alerting me to that. So Dexter says, why bars and not candlesticks? So that's a very good question. And again, to me, I like to look at high, low, and close. It's very important to see how something closes relative to the high and low. Let me just take some of this. So like I said, I mainly look at patterns, and then I look at how something closes within the pattern. And to me, it's much easier to see where something closes relative to high and low on a bar chart. Now, most people are familiar with candlesticks and you'd look for dojis or something like that. To me, it's very cluttered. I can just look at this chart and very quickly, without even, kind of focusing in, I can see this, I can see this, I can see this, I can see this. And those things they stand out at me. They just jump out where you see these reversals. So this, again, I don't just trade reversals in a vacuum, but this was in an area where you made a double top. You went to one price level, backed off, did another one, and we don't really know when we're in the middle of this thing, is this really a reversal? But it's corroborated. When I see what looks like a double top, and then it's corroborated by the price information, meaning it's corroborated by this guy. Right at the all-time high, this stock made a new high, and by the end of the day, the sellers were in control. Then you retested that area, went to a new high, jumped up, whatever it was, $50 on the day. And by the end of the day, the sellers were in control. Now, this is a perfect setup for me, where you get a double top, you get a key reversal, and then in addition to this key reversal, you get an inside bar. So now you have both. You have the key reversal where it made a new high, close on the low. Then it's followed by an inside day bar. So that to me is just a coil. This is just kind of building energy before it releases in the direction indicated by the pattern and the price action. So you don't have to have both. You don't have to have a key reversal. You don't have to have a key reversal. But when you do, it's very, very powerful. Here's a small little example of that. You had a reversal here, then you had a small little inside bar here, and all you had to do is get short underneath there and look at that trend you were put into. So again, it's just a combination of price and price action. And so when I see these reversals, they just stand out to me in the context with the trend. So I'm always looking for, like today, we had a reversal in the Dow and I'm going to end it here. So I'm always looking for confirmation in the direction. So this is the Dow. The Dow is much more murky than the NASDAQ is in a clear downtrend. The Dow is much stronger because we have value over growth. The whole story. But what we have here is this pattern, this resistance level. There is a very clear resistance level here. So this is going to be like a minefield to get through. So once you understand that this is going to be a very hard area to get through, it's very unlikely you're going to see that. So now I'm always looking for the opportunity where this is going to kind of stall out and head back that way. And the evidence I look at is price action. And this is what we had today. We opened higher, went higher, and then started going the other way. And then you could see that once we started going through yesterday's unchanged, that's where I started getting short, right in there, and made, 30, 40 grand just from there to there. So what I start doing is looking at the relationship between the previous day's close, if this opens and if it's sustained one thing, but if it starts coming back, then you start setting the stage for a reversal. Now, one reversal in and of itself is not meaningful enough. You can't make a whole hypothesis here. You still got to get through all this stuff, even if you're going to go lower. So it's going to be it's very difficult trading in this area. It's just, every day is the opposite of the other day. So this is very difficult, and it's very much a trading environment. And you could put a gun against my head, and this thing could go back up tomorrow or go back down. But what I do is I use these key reversals. So what's more than likely is that you might have some trading action here, and then I might just test out, getting short here against today's high. And this is what these key reversals do. They start telling you areas of where your risk is. So trading is all about understanding where your risk is. You know, if you get short here and put your stop there, you can understand what your risk is when you get in something. Now, this is in a very ambiguous area. It's in no man's land. It's trading in the middle. It could do anything. It still needs to resolve itself. We're going to get an inflation number this week. We're going to get pushed all over the place. And so you really have to understand what your risk and your reward is. And so I'm just going to leave you with this. This is a trade that I send out to our elite members. And if you want to get on our list, I'll let you know that tomorrow. So this is the second cousin to Moderna. It's a stock called BNTX. Same chart, really same chart. Huge double top. And whereas Moderna kind of made a new high in here, this basically went right to the top of the trading range and stalled out. And now, to my mind, it's very likely that we're going to continue going to the bottom of this range. This is the guiding pattern. It's been an extended trading range, hit the trading range, and now I think we're going to hit the bottom of it. So that's the weekly chart. So it gives me the big picture. And now I can drill down to the shorter picture. It looks much more kind of zany or arbitrary, if you will. But here again, to my mind, is what's happening on this. You made a new high and you put on this double top here, and within the cadence of that weekly chart. So once I understand the big picture, I can drill down to a smaller time frame and start finding an area where I can find a risk reward for my trade. Now, again, this one's a little bit difficult. The market's just in a very difficult phase, where you have what also looks like could be a head and shoulders, where this would be the one shoulder and this would be the other. Now, this could still take a period of time. It could still kind of bounce around here and, you know, take time to mature. Trades need time to mature. But what happened today is we had this inside day bar where we went higher, closed on the low, and now you have this bar where the range of yesterday is sitting in within the range of today's range, sitting within the range of yesterday. So basically, you can set up a trade where you could get short here, put your stop there, or frankly, maybe up there. And it's still very possible that this thing could, you know, do this before it resolves itself. But this thing is coming down. And so what you want to do is just find ways of legging into this thing. And so once I start understanding what I feel is the big picture, so this top is in. This market has topped. Now, it could come back here before it fails. It could do all kinds of things. But once I feel like I understand something, and using the word understand in trading is probably an arrogant thing to say, but once I feel like I understand what's going on, I start building positions. So if a market actually goes higher, I actually just keep consolidating my position. I add a little bit more so that eventually when it's down here, I can make a piss pot full of dough. So actually when it opened up here and opened right at 151.5, I put a limit in there to sell it at 152 into this opening this morning. Got filled, and I'm up $4 on that trade. And we'll see what happens to tomorrow. But you can see here was this head and shoulders, and you could have taken this for a very nice ride. And I think this is going to transpire in the same way. And that is BNTX. So Simon says, would you generally place more trades on the daily time frame than the weekly? So basically, it depends. Obviously, with the weekly, you're going to get fewer trading opportunities because it's going to take a longer time to complete that bar. So what I'll do is I'll start getting into a position. I'll start finding a place to get in. And then once the market starts confirming that I'm on the right side, then I'll look for other places to add. Goes down, goes up, puts on a key reversal. Then, I'll basically get short here, put my stop loss there, and then keep adding in the direction of the trend. And then at some point, you get into an area where there's support, and this is where you want to start legging out of your trade. So the market actually tells you where to get in and where to get out. So with that said, I'll see you guys tomorrow, 4:30 Eastern time, and take any of your questions, and we'll just keep peeling back the market analysis. So hopefully this will slowly sink in. And if you have any questions, please let me know. I have a book. I'll give you a link to my book tomorrow that will explain in much greater detail my 4-step trading methodology and give you a better handle on how to handle all of these markets, no matter what they're doing. Alan says, thanks, Mark. Awesome section. Thanks for that endorsement, Alan. Really appreciate it. Jamal, Duncan, Dexter, Toby, thank you very much. And I'll see you tomorrow. Thanks again, guys. Bye-bye.